Hi everyone, I'm Bernardo Bortolotti, the Executive Director of the Transition Investment Lab at New York University in Abu Dhabi. This video will go out along with the launch issue of our newsletter entitled Longitude, a brand new publication providing precision insights on transition finance and investment. And today we are diving into big challenges in global finance. And to help us break them down, we have invited a very special guest, Federico Galizia, the Vice President for Risk and Finance at the International Finance Corporation, the largest development finance institution around the world. Federico, it's really a wonderful pleasure to have you here. So welcome to the show.
Piacere mio, Bernardo.
Thanks a lot. So Federico has an incredible wealth of experience in international organizations and financial institutions. So Federico, let's kick off this conversation with something that is very close to our heart as economists, data. So by training, we know that good decisions usually come down to solid data and rigorous analysis. And the IFC, along with other institution, development banks, has recently published the first batch of research using the famous Global Emerging Market Risk Database, GEMS. Can you briefly explain what GEM is and tell us about credit risk in emerging markets?
Thank you, Bernardo, and it's a pleasure to be here. The Global Emerging Risk Database is a collaboration effort between multilateral development banks and development finance institutions. And what became GEMS started out as a bilateral effort between the International Finance Corporation and the European Investment Bank to put loan-level data in common on an anonymous basis. And why is it important to look at loan-level data in banking? Because you use them for your risk management. You use them for your risk models, to allocate capital, to calibrate your pricing models, and so forth. And this was 15 years ago as an experiment. It became very attractive, this idea, to other institutions. And now we are 27, 28 institutions, all engaged in development globally with this database. We also created a community of learning around the database. So we have data analysts and specialists in the various risk management departments who constantly work throughout the year and even get together in plenary sessions to ensure that we can compare the default and recovery experience of the institutions. And those are going to be the key words in the rest of our discussion. Default means a company falls behind in its payments, and it's very important to measure the default frequency of loan portfolios. And recovery is what happens through the workout process. How much investors are able to recoup after a company falls behind in their payments. GEMS, publication of default and recovery rates, globally, by country, by sector, has been a game changer in development finance.
And Federico, this is fantastic news for us as researchers. And can you just add a little bit of color about the first results that are emerging from this early research? So what is the data telling us about credit risk in these markets?
Something unexpected. When investors think of emerging markets, they use the sovereign rating as their entry point. So they say a country is rated single B or triple C. Typically, your triple C default with a frequency of 15-20%, your single B with a frequency of 5 to 10%. And they assume, investors assume that everything inside the country will behave the same way. What GEMS is finding is that in low-income countries, the default rates of our private sector portfolio is only half of what the sovereign expected default rates are. So half the risk when you work with private companies vis-a-vis your average low-income sovereign ratings. And that is proving both a puzzle which needs to be explained with further research, but also a very attractive proposition for investing. And these are real loans. This is 30 years of history of multilateral development banks investing in low-income and middle-income countries.
Well, this is fantastic, Federico, because apparently, well, the jury is out, so we don't know yet. We need more research, more data, but point to something quite interesting, which is possibly a major repricing of risk in these markets if new evidence, if new data are coming, still confirming, providing solid evidence that these default rates and overall credit risk could be somehow lower than actually perceived. So let me just pick your brain on a related topic, which is clearly development finance, which so far has been, I would say, exclusive remit of governments and multilateral donors, and often associated with concessionary returns. So the question that I have and the curiosity is there a chance that maybe thanks to this new wealth of data, development finance could become a sort of new asset class in its own right, possibly combining attractive risk-adjusted returns with impact. So what is your view on this possible opportunity?
You said it, Bernardo, attractive risk-adjusted returns. What we're seeing when we look at the actual default experience is clearly not investment grade, meaning we're below the BBB threshold, but in an area where investors will be very comfortable investing within their own country. Most savings in an economy are invested in the single B to double B range because the investment grade assets are a minority of where savings go. Think about your house, think about a small business, etc. When it comes to emerging markets, the same risk produces risk aversion in savings. And what we're showing is that the type of spreads that multilateral development banks are charging, which are handful of percentage points, as opposed to a dozen of percentage points. So a handful of percentage points is an adequate remuneration for the risk taken, because multilateral development banks are able to structure risks in a way that is commensurate to pricing. This is where risk return really comes together. And I think the reluctance, the risk aversion of many investors vis-a-vis emerging markets can be nudged into investing by this data. Now, do I expect a massive wall of finance to arrive? No, because I think investors will retain a domestic bias for putting their savings. Investors traditionally choose their own currency and their own country, which they know well, to invest. This is well documented in research. But the amount of savings in advanced economies is so large that even a small fraction of those savings can make a difference, particularly in low and low middle income countries.
We will get to that for sure. It's going to be a fantastic topic for our question. But now I also would like to ask you, have your view about how we can manage to bridge the so-called investment gap. So we know that we have this sort of $4.5 trillion of annual investments that are needed to deliver somehow upon the sustainable development goals. And we know that we will never make it, so we'll never progress absent a meaningful collaboration and partnership between multiple players from the private and public spheres. What you're saying concerning the risk mitigation strategies that IFC and the ecosystem of donors are providing to loans is interesting because it points towards some possible collaboration that we could develop between yourself, your ecosystem, and institutional investors, also in developed markets. So I was wondering, how does the IFC embrace partnership and collaboration? Is there anything that you want to share about IFC's efforts toward private capital mobilization in a collaborative fashion?
At the heart of the IFC's Articles of Agreement, from the very foundation of IFC, is a mission to mobilize capital towards emerging markets. That's in our DNA. And we've done it from the very beginning. The IFC very rarely takes 100% of an investment. We always syndicate it out to our partners. And partnerships have evolved in size, nature, and arrangements over our existence. At the beginning, it was very much a loan-by-loan syndication. We had a club of institutions that were well familiar with our credit policy, trusted our underwriting criteria, and took portions of our loans or equity investments. Then progressively, we moved to pools of co-investment. We set up an asset management company. We set up managed portfolios where investors can pre-commit ex ante, and then we bring them alongside us if the loan meet certain criteria. And what we have now in the studying is even a securitization platform, sort of an originate to share model to bring investors along. And this last step is very important because when you mention the trillions, the management teams that within asset management companies need to mobilize those trillions, they need a minimum ticket size. Many of our projects are 50 to 100 million. But that is the typical large advanced economy asset manager is looking for a minimum investment size of 500 million. So we need to somehow find a way to warehouse and then mobilize a sufficient critical mass that would justify the investment from a large asset manager.
Thanks a lot. This is great piece of new and important details about the originate to share model, which seems extremely promising, especially if we want to address the challenge that we like to call the great reallocation. What is the great reallocation? Well, it's the fact that you have hundreds of trillions of dollars in global wealth that are sitting in developed markets and primarily the US. But we know that the real need for sustainable investment is in the global south. We know that there are home biases. We know that there are ticket size issues. But how do we fix, or can we fix this? How can we deal with this great reallocation, which is badly needed? So we need to get capital flowing where it's needed most to drive real and lasting change and delivering on sustainable development. So is there a way in which this reallocation would ever occur?
It's a good question, and it has to do with find a way to distribute risks to the parties that are best equipped to take that risk. So take political institutional risk. There are insurers that specialize in political institutional risk and they know how to underwrite it. And we need to have them on the line. Then we have specialized macro funds that invest in currency risk or maturity transformation in emerging market conferences. We need to have them at the table. Then we've got the advanced economy currency-based investors, long money investors in dollars, in euros, in yen, and so forth. We need to have them at the table. And we need the project origination capacity that comes from us multilaterals and from the domestic markets. So it's a risk management and risk allocation effort if we want to pull it through. But increasingly, we're seeing this ecosystem developing. And let me just add one last very important piece of the puzzle, which is domestic capital markets. There are many emerging markets have now emerged, at least as it concerns their internal money markets, their banking system, the central bank. They have inflation under control. They have the ability to finance their productive system in local currency. We also need that part. And you need the domestic local currency market to talk to the foreign currency markets through the appropriate amount foreign exchange instruments to close the circle.
Federico, again, thank you very much for joining this chat with us. It's the very first episode of the podcast of the Longitude, and it's a fantastic start. So again, I'm extremely thankful. and thank yourself and your team for making all this possible. And you, viewers, stay tuned for our next episode.